Ladies and gentlemen, good day and welcome to Mahindra Lifespaces Developers Limited Q4 FY21 earnings conference call. We have with us today Mr. Arvind Subramanian, Managing Director and Chief Executive Officer, Mr. Vimal Agarwal, Chief Financial Officer, and Mr. Sumit Kasat, Head Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arvind Subramanian, MD and CEO. Thank you, and over to you, sir.
Thank you, Neerav. Thank you to all of you who joined the call. Good morning and welcome to our Q4 FY21 earnings call. I wanted to take a moment at the start. We recently lost one of our dear colleagues at the start of this week to the COVID pandemic, and I'm sure many of you have also had both colleagues as well as near and dear ones affected by the pandemic. And I wanted to take a moment with you, request you to join me in a moment's silence to remember those who've been badly hit by this pandemic. Thank you. As all of you know, many of our key operating entities from the residential business like Mahindra Homes, Mahindra Happinest and others, as well as in our IC and IC business, Mahindra World City Developers Limited, Mahindra World City Jaipur Limited and Mahindra Integrated Parks Limited are not consolidated on a line-by-line basis, and I request you to view our financials with that lens. Let me give you kind of a quick synopsis of how we are seeing the macro environment, and then I'll talk about the company's performance and outlook for the coming years. So from a macro perspective, as we know, last year has been a very, very challenging year. We've had a contraction in GDP, while Q4 showed a sharp rebound, and we hope that that is a sign of things to come, that when the pandemic eases, there will be a sharp rebound in the economy. The IIP index as well showed a similar pattern. It was muted at the start of the year and then a sharp rebound towards the end of the year. Retail loan growth showed a strong recovery. In the real estate sector, Q4 by all accounts across markets has been very strong from a demand perspective. There was almost a 44% sales growth reported in Q4 F21 compared to the same quarter in F20. And we are seeing that demand is resurfaced and bounced back across all price segments. So it's not limited to any particular price segment or ticket size. There is a very clear preference for ready or near ready inventory, and we are also seeing indications that customers are wanting to upgrade to either slightly larger homes or homes which are better suited to their needs in terms of facilities and amenities. The demand drivers underlying this are multi-decade low mortgage rates, which has boosted affordability. specific regulatory interventions like the stamp duty reduction in Maharashtra, which certainly provided tailwinds to the industry, and some pent-up demand from the first half of the year coming into the second half. Turning our attention to Mahindra Lifespaces and how we have performed, I wanted to take you back to the key pillars or the key elements of our roadmap that I had laid out when I spoke to you in July. One, I had said that by FY25, we should be getting to 2,500 crores of residential sales. The second I had talked about was the hidden value of the industrial business, the IC and IC business, and with all that is happening with global supply chains and relocation of manufacturing, I had expressed hope that that could be a hidden gem. And third, there was already indications, even from previous years prior to the pandemic, that there is a structural shift happening in the industry. So I'll use these three anchors to also talk about how we've seen the year that has gone by as well as the years that are ahead of us. So firstly, are we on track to achieve the goal of 2,500 crores of sales by 2025? I feel very confident now, even more confident than I was when I first spoke to you about this in July of last year, that we are indeed on track. And why do I say that? One, we've shown now repeatedly across many new project launches that we are able to bring new products to market with significant impact and significant velocity at launch. All the way back to Roots, Centralis, Happinest Kalyan, Happinest Palghar, Happinest Kathode, all of these projects have sold upwards of 80% within the first 6 to 9 months of launch. And that gives us a lot of confidence that we have the fundamental capabilities, platforms, the product thinking that is resonating with where we see the demand. The second is from a supply perspective. So the pipeline of land. Again, I had told you we will be targeting about roughly 4 land transactions every year, aggregating to about 2,000 crores worth of sales potential, so that we build a good pipeline, which will provide quote-unquote dry powder to get to the 2,500 crores sales target. And indeed, we are again well on track for that. We've done over the 9 months since we last spoke, 3 transactions, 2. The first was in February in Kanakpura. Then in March we announced an acquisition in Kalyan, and in early April we announced an acquisition in Pimpri and Pune. Between these are just a shade under 1,500 crores. So in 9 months we've done 1,500 crores worth of sales potential, and we feel, looking at the pipeline that we have, that we are well on track to achieving the milestone I had set of getting to 2,000 crores worth of GDV addition every year for the next few years. Now these steps and this kind of early success is coming against a backdrop of an industry that is really getting fundamentally reshaped. It's very clear that there is a perfect storm brewing which is favoring the more formalized players. And this is happening in at least 4 different spheres. One, as we have seen, demand is migrating to the more formal sector, particularly under construction demand, pre-sales demand. Most customers are not willing to trust unknown developers or developers who don't have the track record of delivery. The second is from a capital perspective, both access to capital as well as cost of capital. There is a significant advantage that players like us are able to derive over local competitors. We have probably a 500 or 600 basis points advantage on a cost of capital, and more importantly, access to capital has gotten skewed towards the more well-funded players with strong balance sheets and strong track record of governance. The third area where this consolidation is playing out is in land supply. Again, we are seeing several deals where landowners are clear in their minds now that they would only like to deal with well-funded formal sector players. Even if it means they sacrifice a few crores or a few percentage points of potential land value, they believe that the surety of the deal being consummated is much higher when they have a counterparty like us sitting across the table. And the fourth area, which is also very important, is talent. Again, real estate has historically not been an attractive sector for talent. But today, talent is getting attracted to the sector, but is choosing to work with the more corporate, the more formal players. And that, I think, is as important as the other factors that I did. And the third pillar was the IC and IC business. As I said, with what's happening around the globe, it is only a matter of time, I believe, that this business will start coming into the limelight. The advantage we have is that we are past the investment phase in this business. All our facilities are shovel ready and stand head and shoulders above the competition in terms of the quality of infrastructure, the quality of services. In a recent customer satisfaction survey that we had done with all our clients in the two world cities, Mahindra World City, Chennai and Jaipur, we got resoundingly positive feedback on how these facilities were able to get ready to bring manufacturing back or manufacturing activity back much sooner than their peers in those locations. And these have become case studies in the two locations. The local government, local administration came and studied how we were able to bounce back from the pandemic and the lockdowns to facilitate our clients returning to business, and have asked for our help to do the same with other industrial parks under their supervision. Turning to some of the key highlights in terms of numbers, sales was perhaps one of the strongest beacons of our performance last year. We've achieved annual sales of 695 crores, which, given the standing start we had for the year, Q1, as you recall, was a complete washout and Q2 was very weak as well. Being able to get to close to 700 crores, which is higher than what we had done in the previous year, is, I think, a wonderful achievement. Within that, the split has also been very balanced. What really gives me a great amount of confidence for the future is that this 700 crores was not achieved on the back of one or two star performers. It was a very broad-based performance. About 60% of that came from our mid-premium portfolio and 40% from our affordable portfolio. Finished goods contributed to roughly a third, about 34% of that sales value. And new launches was again about 260 crores out of the 695 crores. So which tells you that we've been able to sell under construction projects, we've been able to sell in sustenance, not just new launches, and we've been able to sell across price points and across geographies. In Q4, we achieved a quarterly sales of 346 crores out of that 695 crores. So almost half the annual sales was done in the last quarter. That is not a surprise, given, as I said, the first two quarters were extremely weak because of the lockdowns. Our average price realization for the year stood at 6,528 rupees a square. In terms of new launches, we launched just under 1 million square feet, so 9.4 lakh square feet across 4 different projects. 2 were new projects that we brought to market, and 2 were further phases of existing projects. The new projects were Alcove, which is our Sakinaka project, which after many years we were able to resolve the approval issues and bring it to market in March. That was about 1.5 lakh square feet. And Happinest Tathawade, which is about 500,000 square feet in Pune. I wanted to call out in particular the performance of Happinest Tathawade. It has been very heartening. Within a span of about 3 weeks, we were able to sell 80% of the launched inventory. We launched about 420 units. We sold roughly 340 units within a span of 3 weeks. all our 2 BHKs in this project were sold out for pre-launch. And about 60% of our 1 BHKs were sold. And this is a market that has historically favored 2 BHKs. So it augurs very well for us because the forthcoming inventory is more heavily skewed towards 2 BHKs. In terms of the land pipeline, as I told you, we concluded 2 transactions in the last financial year and 1 in the early part of this year, in early April of this financial year. Both those transactions, which is Kalyan as well as Kanakpura, as well as the Pimpri transaction that was agreed upon with where Mahindra & Mahindra is the seller, we are expecting to bring to market within this financial year itself. So they've been structured in a way, and our preparation is at the level where we will get approvals and be able to launch, fingers crossed, within this financial year. Beyond these 3 deals, we have a very strong pipeline going into F22. It's a mix of outright with approvals in the landowner scope, joint development agreements, and society redevelopment agreements. In terms of collections and handovers, we've achieved an annual collection of 758 crores, which again is very, very heartening. In these difficult times, the fact that we've been able to achieve close to 800 crores or 750 crores of collections and have very little bad debt or long-term defaults in that pool is again an indication of the trust that customers have placed in us. We've handed over 605 units over the financial year, 445 of which were handed over in the 4th quarter. Completions has been a little bit of a challenge, candidly. The first 2 quarters we had significant challenges on labor availability. For the first quarter, labor was available on site, but we were not allowed to work. And then as soon as the lockdown was lifted, most of the migrant labor expectedly and understandably wanted to move back to their villages. And we had to rebuild the labor force. We were able to rebuild it to almost 80-90% of the pre-pandemic levels by Q4. But the second lockdown, which started in mid-March, has again put the brakes on construction activity. That has resulted in a few completions slipping from Q4 to potentially Q1 of this financial year, and that has impacted our financials. On the IC&IC business, annual leasing volume has been 55.6 acres, aggregating to 128.7 crores. And again, this needs to be viewed with the understanding that international travel has been severely restricted. And many of our clients for our industrial parks are multinational companies and their global teams, their global manufacturing and supply chain teams who typically visit every site before they decide on a new factory location. So we have a good build-up in pipeline, but the consummation of those deals is taking longer than usual because of the international travel restrictions. Out of those 55.6 acres that were done in the year, again, almost more than half, 27.8 acres or 66.4 crores in value terms, was done in Q4 of F21. Again, an indication that as the economy opened up, as travel opened up, there was a strong conversion of the pipeline into actual sales. Many of the initiatives that the government has taken, whether it is the PLI schemes that have been announced, the softening of interest rates and credit availability, the lower tax rates for new manufacturing facilities, coupled with the global realignment of manufacturing supply chains, I think bodes well for this business in the years to come. We are also getting many inquiries for build-to-suit facilities and warehousing in our industrial parks, and we are in the process of evaluating what is the best way to serve this demand. So overall, I am cautiously optimistic on this segment of our business. Let me turn the call over to Vimal to take you through the financials.
Thank you, Arvind, and good morning, everyone. I'll take you through the high-level financial performance for Q4 versus Q3 F21, as well as for full year financial 21 and FY20 as well. Starting with the quarter, the consolidated total income stood at 58 crores as against 70 crores in Q3 F21. The consolidated EBITDA, including other income and share of profit from our JVs, stood at negative 30 crores as against negative 3 crores in Q3 F21. The loss is post including the investments we have made in the market on new project launches. That's an important point I wanted you to note, please. The consolidated PAT after non-controlling interest stood at negative 27 crores against negative 11 crores in Q3 F21. Moving to financial performance for F21, the consolidated total income stood at 188 crores as against 646 crores in FY20. The consolidated EBITDA, including other income and share of profit, stood at negative 60 crores as against negative 46 crores in FY20. The consolidated PAT post minority interest stood at negative 72 crores as against negative 193 crores in FY20. At present, the company has debt of 244 crores at consolidated level, while cash in hand and bank balance is about 135 crores. The cost of debt for India's consolidated entities is 7.05%, while the standalone cost of debt for Mahindra Lifespaces is about 5.9%. Thank you. We can open the floor for questions, Neerav.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Parikshit Kandapal from HDFC Securities. Please go ahead.
Hi, Arvind. Congratulations on a very sharp rebound in the fourth quarter and comeback of the pre-sales. So my first question was, you did touch about the 3 large landings which you did. I think Bangalore was the old one. I think it got consummated. So technically, if you see the 2 new landings happen, so one is Kalyan and Pune. And Pune was also kind of a related party. So just wanted to know that we were doing a couple of large landings in NMR, I think Borivali and Dahisar. So if you can update within the land BD, what is the pipeline for NMR, for Pune? Also, if there is any MOUs which we have signed for any redevelopment, because you did mention about redevelopment. So over the next 3 to, at least in 1H, what is the visibility of the large deals happening? And beyond that, how is the pipeline looking in terms of overall pre-sales potential cumulative?
Yeah, thanks, Parikshit. Sorry, your voice was a little bit muffled, but I think I got the essence of your question on the land deals, both trying to explain the deals that we've done and what that means, as well as the pipeline going forward. So as you rightly said, the 2 deals that were done last year, Bangalore was something that we had kind of shook hands on and initiated almost a year and a half back, but it did go through its ups and downs, and we're very happy that we consummated the deal in February. We are hoping to bring it to market in Q3 of the current financial year and are well on track to do that. Most of the approvals are in place. There are some final things to be sorted out before we are able to launch it. Similarly, the Kalyan land parcel of close to 10 acres is again a very attractive land parcel where we've structured the deal in a manner where the landowner is getting us the approval. So there's a small upfront land payment and most of the consideration will be paid closer to launch. And that is generally the principle that we're trying to follow in most of our land acquisition. We're trying to defer the land payouts to as close to launch as possible. So one of the questions I have got in the past from analysts and investors is, how quickly can you consummate the land deal? I think more than consummating the land deal, it is about how quickly can we launch, which is our main focus. And we try and push out the consummation of the deal to as close to the launch as possible. So all these 3 land parcels, Bangalore, Kanakpura in Bangalore, Kalyan in MMR, and Pimpri in Pune, we are very much on track to launch within this financial year. And that is very important for us. In terms of the pipeline going forward, as I had mentioned in my opening comments, it's a very strong pipeline. I'm extremely confident that we will be able to stay true to our intent of doing 2,000 crores worth of GDV addition year on year for the next couple of years and keep building up from that. 2,000 crores is only the first milestone. We will keep growing beyond that. And the nature of the transactions is also very encouraging. As I said, it's not all outright. It is partly outright, partly revenue share, joint developments, and some interesting opportunities around society redevelopments and distressed assets as well.
So in terms of value, how do you see this? Is it like 10,000 crores of potential worth of deals you are in advanced stages or in negotiation? How do you quantify the size just to get some sense on where we are heading?
Yeah, so it's the same metrics. So as I said, 2,000 crores worth of GDV addition. The next stage of our pipeline, which is still in kind of final negotiations and negotiation of terms, etc., would add up to about 4,500 crores.
Okay, so 4,500 crores of active advanced stages, land negotiations, and is going on currently. This is what you.
Yes.
And
look, I would want to caution that doesn't mean the entire 4,500 crores will be consummated. That's why it's a pipeline. It is not a done deal.
Just on the large 2 transaction investment suburbs, which we will be planning for some time. So any hiccups there? I mean, because it has been taking some time now, because I think we were planning to close it by March, so we are already in May now. So any fallback on any of these kind of transactions that we already
no calls. Honestly, no cause for concern. It is more about kind of making sure that we are extremely comfortable with the terms. That in all these cases, the diligence is largely completed, so there's no concern around title or any other legal aspects. It is more dotting the I's and crossing the T's on the terms. We don't want to do these deals with a gun held to our head saying, we had said March 31st, therefore it must be March 31st. So like in the case of Pimpri, it did slip into the first fortnight of April. That's fine as long as we get a good deal. That's more important.
Okay,
but no cause for concern on those transactions.
Just lastly, one more question on this. So we have seen our presence now in Central and Western Line. We are looking at something. So we are seeing good redevelopment opportunities emerging and some of the organized developers coming in the Navi Mumbai redevelopment market. So are we looking at it in terms of growth and expansion within the MMR region?
Yes. So in MMR, we are looking at Navi Mumbai very actively and have some advanced conversations there as well. So as you rightly said, our footprint in MMR will be Western, Central, and Navi Mumbai.
Okay. I mean, that's some more questions on John. Thank you so much.
Thanks.
Thank you. The next question is from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah. Good morning, everyone. Thanks for the opportunity. So just a follow-up on previous question. So for this 1,500 crores of sales value, sir, could you give us what would be sort of indicative margins or what is the target margins you are going to be working with? If you could just break up into land and construction spends, how much would that attribute to overall for these projects?
Land and construction spend, I will have to put it together, but indicative margins, we definitely target margins and IRRs in the high teens. And these I'm talking about project IRRs, so equity IRRs should be much higher. Margins, in fact, should be in the early 20s. That's our investment hurdle in all our projects.
Okay. So where I'm coming from means, what you saying that we'll be looking at around 500 crores of land spend annually, right, going forward. So is it the yearly basis? This is the outgo you would have incurred in FY21. If you just share that number on land cost and approvals, how much you would have spent overall?
No, in FY21 it would be much lower because, as I said, most of our land transactions are structured with deferred payments. So the actual outgo will happen closer to the launch. in all these three transactions that we've closed. I mean, two have been closed in FY21. Technically, one is early FY22. But let me talk about all three since they are all confirmed dates.
Okay. Okay. So for this year, what would be the guidance for FY22? How much would you end up, including all the advances and everything? What would be the indicative number for that?
Yeah, so I think this year would be in the range of that 500 crores because we will add another 2,000 crores plus of GDV pipeline and consummating the earlier deals plus the first tranche of the new deals would end up to the range of 500 crores. Again, it will vary depending on the mix between JDAs and outrights. As you well know, with JDAs, the upfront payment is much lower.
Sure. That's fine. Secondly, sir, obviously I know that we are impacted by COVID and all. So how are you looking at sales for this year? Is there an upper end or lower end of guidance which you are looking at for the residential business?
Look, as I said, we are still on track and are committed to getting to that 2,500 crores by FY25. So starting at roughly 700 crores last year, you can interpolate the numbers between that. I don't want to give year-on-year guidance, but we are holding fast with our midterm guidance of 2,500 crores.
Okay.
And that is, look, even the 2,500 crores, I must emphasize, is just the first milestone. So if one were to think of it as a Everest trek, this 2,500 crores is base camp. It's about consolidating at that level and then moving up to 4,000 crores and 5,000 crores, etc. beyond that.
Sure. So and the last question is a combined question on the impact of the rise in the raw material prices and also what is the labor availability currently across sites, you think, post the onset of COVID? Yeah, these two.
I think that's a great question, Adhidev. And in fact, to me, the supply side of the equation in our business is more worrying than the demand side. I think we've seen enough indicators last year that when the market opens up, the demand for housing and particularly good quality housing is extremely strong. On the supply side, however, both with the commodity price growth, steel having gone up by almost 50% over the last year from 40,000 rupees a ton to 60,000 rupees a ton roughly, cement prices going up and labor availability being a huge challenge with frequent lockdowns. And that is, unfortunately, it appears is going to be here to stay for much of this financial year. So to me, the supply side is the bigger worry, and we are working with all our contractors and suppliers to try and mitigate some of these risks.
Okay. So and just the labor, is there any percentage in terms of how much labor do you have on site now after this currently compared to a couple of months back? Yeah.
So Q4, we were tracking at roughly 80% of our need across all the sites. We've lost about 1/4 of that in the last 1 month. So we're down to about 60%.
Okay. Fine for that. I'll come back in the queue.
One point.
Yeah, tell me. Sorry. Yeah,
just one point I wanted to mention on the labor front. Post wave 1, the pace at which we ramped up was significantly higher and very, very heartening. Say in August, September, October, we saw very quick ramp up. And to that extent, right now we are extremely confident that if this wave 2 subsides, the ramp up will be equally strong this time as well.
Sure. That's pretty helpful. Yeah. Thank you, gentlemen. I'll come back in the queue for questions. Thank you.
Thank you. The next question is from the line of Amit Dalal from Tata Investment Corporation. Please go ahead.
Congratulations, Arvind, on this heartening note with which you are presenting the results and the fact that you are on target or even better in terms of the land acquisitions. I wanted to know strategically now, there was one call which I had attended with the new managing director of Mahindra & Mahindra. Is real estate going to remain a focal area for the house? It was something that frankly I didn't get a very clear answer from him. And is there capital going to be, not that you need it right now, but perhaps something that the house would not shy away from investing into? And another housekeeping suggestion I have before you answer my question is, can you in the presentation share with us P&L on the Schedule 6 basis because this Ind AS, as we all know, has screwed up everyone in kind of figuring out exactly the numbers.
Sure. So, Amit, firstly, I hope you're doing well. Good speaking to you. It's been a few months since we last spoke. On the Schedule 6, I'd request Vimal and his team to come back to you and others with that. As you said, it's very hard to decipher Ind AS accounts in our business these days. Coming to your first question on where does real estate fit in the portfolio of the group, honestly, Anish and the team are the right people to answer this. But, let me just share a few indicators. One, Anish sits on our board and continues to sit on our board. So that is one sign of commitment. Two, we did do the Pimpri transaction with M&M earlier in April, which again is an indicator. I'm not saying it's a commitment that given both M&M is listed, we are listed, we will have clear arm's length transactions between the two companies. But both of these are indicators that the group is supportive of the business. I think the capital allocation discipline that has been brought in the group over the last 12 to 18 months is a good thing. And I don't shy away from being asked to be accountable for return on equity, and I'm sure all of you would want me to be accountable for that as well. So I see that as a positive. It kind of keeps us honest, keeps us focused on doing the right things for the business and making sure we deploy capital wisely. At this stage, we've not had a capital need that we've gone back to the group asking them to put more capital in right now. I think we are quite comfortable from a balance sheet perspective. If we are able to deliver on the hurdles that the group has set out, Anish has been very explicit on that in the public domain. He wants companies to track to an 18% ROE. I don't see any reason why the group would not be supported.
Excellent. And yes, I should perhaps have asked you first. I hope everybody is all right in the Mahindra Life family with regard to COVID.
Touch wood, mostly unscathed. As I mentioned at the start of the call, we did lose one of our colleagues at the start of this week, which was a deep personal setback for me as well as my colleagues.
Sorry, your voice is gone.
Can you hear me now?
Yeah, now I can. Sorry, you were saying about a colleague and I didn't hear the rest.
Yeah, no, we lost a colleague at the start of this
I'm
week.
so sorry to hear. Okay.
That was a pretty deep personal setback and a setback for our team as well.
My condolences. Yeah. That's all I have to ask.
Thank you.
Thank you. The next question is from the line of Manish Agarwal from JM Financial Service. Please go ahead.
Yeah, good morning. Thank you for the opportunity. So I was just looking at the sales number for 4Q FY20 and 21. So there seems to be a decline this quarter. So any particular reason? Is it because of timing of project launches or something like that?
Sorry, Manish, I wasn't able to hear you at the start of your question. This is what are you comparing from FY20 to 20?
So this quarter, 4Q FY21 compared to 4Q FY20. So there seems to be a decline this quarter. So is it mainly because due to delay in project launches? So this year you might have launched in March. Last year it was earlier, something like that? Or any particular reason?
Which parameter are you looking at when you say decline?
Sales value.
Sales value, look, I think in our business, as you know, it's fairly lumpy from a launch perspective. Overall, this year, fourth quarter has been a fantastic quarter for us. Half our annual sales have been done in the fourth quarter. If I were to try and understand the reasons, fourth quarter last year, we had the Kalyan sales getting logged in. Fourth quarter this year, we have Tathawade and Alcove as new projects, which were smaller than Kalyan. So that could be one of the reasons. But our sustenance sales has been very strong right through the year and also in Q4. So that has partly offset that.
Okay, understood. And secondly, in terms of the land inventory which you give in the presentation for forthcoming projects, so it seems that you have reassessed that. So this quarter, the presentation shows 5.74 million square feet, while earlier presentations used to report 10.44 million square feet. So any particular reason, and which land parcel is this specifically?
So this is in our Mahindra World City, Chennai, and our thinking is that we will repurpose some of that land for industrial because we've run out of industrial land in Mahindra World City, Chennai, and the demand continues to be strong.
Okay. And what sort of realizations can you get? So this will be normal, the realizations which you're currently getting around 3.5 crore per acre. So it will be converted into that kind of land?
Yes, the expectation is that or higher than.
Okay. And any broad metric as to how much acres it can be converted into? So this was into million square feet.
My understanding is it's roughly 50 acres available,
Okay.
which can be converted into industrial.
Okay.
And we can be flexible about that, to be honest. So, as the demand picks up, we can choose one asset class or the other in that land park.
And specifically, last question is related to Ahmedabad. So are we planning to launch it anytime soon? And what sort of demand should we expect in terms of leasing acres?
Yeah. So, we have in fact built a reasonable pipeline of inquiries there. So hopefully within this financial year, we should have our anchor clients and more than just our anchor clients, probably 2 or 3 clients is the target for this financial year. From an infrastructure readiness perspective, it's fantastically developed. The access to the highway is very clear. So it's well located and great infrastructure.
And realizations would be closer to Jaipur or Chennai?
Realizations will be similar to our origins Chennai.
Okay. Thank you. That's all from my side. Thank you very much.
Thank you. The next question is from the line of Susmit Patodia from Motilal Oswal Asset Management. Please go ahead.
Hi, good morning, team, and accept our condolences. Sorry for this. My first question is, if I look at the cash flow statement, your spend on the land is 3.7 crores only, right? Is that correct? For FY21?
So, Smith, we are not able to hear you well.
The spend on the land in your cash flow statement shows at 3.7 crores.
No. So, Sumit, our land investment actually form part of working capital movement in inventory. And to that extent, the spends are definitely in 3 digits. I just need to check it again as to exactly how much it is, but it's definitely much higher than 100 crores and above.
Okay. Got it. And the second question is, you have put a water flow chart of the 2,500 crores estimated cash flow. This is net of costs that you projected?
Yes.
It is net of the construction costs, Smith. So sales manage the construction and other direct costs, like approvals and all.
Got it. Also, just the last question is, since most of your land payments may happen in FY21, what is the planning on debt? Or would you just go the debt way, or would you do further equity dilution?
Our experience in F21 is there was this COVID. We do had slow pace of construction, but if you look at our collection number, those continues to be as strong as ever. What it means is that our ability to use the cash, which is internal accrual, is very high. Second, just to give you a couple of examples, in MLDL, our cost of borrowing right now is average is about 5.9 or 6%. And therefore, it's a question of optimizing between the two, which is internal accruals and the borrowings. And the third point is, if there are opportunities which we are evaluating actively right now, is to create platforms. And whatever works out well is what we will do. And, I just want to specifically call out, and Arvind also highlighted, the plan or the focus is not only the next 3 quarters or 4 quarters, it's definitely midterm, which is say next 2 to 4 years.
Got it. Thank you, and all the best, and stay safe. Thank you.
Thanks.
Thank you. The next question is from the line of Mahavir Mehta, an individual investor. Please go ahead.
Yeah. Good morning, sir. I would like to ask you one thing. In IC and IC, we have sold 27.8 acres in this quarter. How much profit we have earned on it, and why there is no effect of it in consolidated profit and loss account? Second one, in 2019 we have launched 15 lakh square feet of project. Which are those projects and when they will be completed? Third question, at what EBITDA we are currently looking to buy land parcel? And fourth and last one, at what rate we are selling SEZ and DTA in Jaipur?
Sure. So firstly, morning Mahavir ji, very good to speak to you. Vimal, do you want to take the first couple of questions?
Yeah. So far as our profitability is concerned, Mahavir ji, on a blended basis, our profitability will be, or the contribution margins in our IC business will be upwards of 50%.
Okay.
And to that extent, if we have done a transaction of say 29 crores, we would have made about average realization would have been say 2.4 crores per acre, very rough numbers.
Okay.
Or 2.4, 2.3. And to that extent, 50% is the gross margin which we make. Now, why is it not reflecting in the profitability? Is largely driven by two things. One is Ind AS, which is you have to make few investments upfront. Just to give you an example, say marketing, where you spend the money and you hope to reap the benefits once you get into closer to completion of projects. The second is also COVID to some extent, where and we follow, as you know, very prudent accounting. There are instances where we have gone ahead and charged some of the interest cost, which in a normal year we would have gone ahead and inventorized into the P&L.
Okay.
All out. Yeah. So I think anything else you want me to take?
No, that's it. Okay, thank you so much. And in 2019, we have launched 15 lakh square feet of project. So it's almost 2 years. So when these projects will be completed, and which are those projects?
Sumit, would you have that information? 2019, I'm guessing, was Roots and...
So last year, in 2019, Mr. Mahavir was referring to 1.55 million square foot of projects that we have launched. These include Kalyan. Large part of this 1.55 is the Kalyan, which is 8 lakh square foot.
No, last year, 2019.
19.
FY19.
FY19.
I think it's Roots, Lakewoods, and...
it's Roots, Lakewoods, and Central East. These three projects were there in that year.
Okay.
So I think, Mahavirji, all these three projects are expected to complete between this fiscal and next fiscal.
Okay, within 1.5 years, right?
Yeah, between these two fiscals. Spread over this fiscal.
Okay. And what EBITDA we are currently looking to buy land parcel, like 20%, 25%, 30%?
Yeah, so we look at margins excess of 20%, as I mentioned earlier. PBT margins in excess of 20%, and project IRRs in the high teens.
Okay, sir. And at what rate we are selling SEZ and DTA in Jaipur? Like SEZ must be actually much more costlier than DTA, right?
Yeah, that's right. So effectively right now, see, one way to look at it is the same World City. Right now, because of certain tax incentives and benefits which are not there and there is a bit of confusion, we are seeing our DTA realization much better at about maybe 2.7 crores versus the SEZ, which is I think 20-25% lower, or maybe slightly, maybe 30% lower as of now. But our sense is that once the overall economy picks up, there will be demand which will come back for DTA as well as for SEZ to a large extent, and therefore the gap between the two should drop significantly over the next 2 to 3 years.
Thank you so much.
Thanks, Swamiji.
Thank you. The next question is from the line of Prem Khurana from Anand Rathi Shares and Stock Brokers Limited. Please go ahead.
Yeah, hi, good morning. Thanks for taking my question. Most of my questions have already been answered, just two from my side. So one was on business development. So basically what I want to understand was, whenever you kind of get into a transaction or evaluating a transaction, so do you go with a preset mind as to which product category are you kind of evaluating this land parcel for? And why I ask this is essentially because I think when we bought Tathiawadi, we were under the impression, or we were made to believe that it would come as a mid-premium, but then now it has been launched as a happiness product. And so the idea was to try and understand how easy or difficult is it to kind of switch between products, because the dynamics tend to be different, right? So happiness would be better sales velocity versus mid-premium, which would be better value product.
Yeah, I think great question, Prem. So yes, at the evaluation stage, we do have a point of view around the positioning of the product. But as was the case that you pointed out in Tathiawadi, we are also flexible enough to take smart calls closer to the launch. In the case of Tathiawadi, when we reassessed the market, we felt that the more compact sizing and a smart product, which is essentially our happiness sweet spot, would work better for that market, and the launch has proven us right for the kind of response we got.
Sure. And sir, would it be possible for you to share the way your IRRs would have changed because of the change in the product type? I mean, when we entered into the transaction and the way the things are now? So I understand ROC would be higher for your the happiness product because sales velocity is better, which is where your collections could slightly be faster, but there could be a situation wherein the margins could slightly be lower than what you would have been able to make with mid-premium. So possible to share how has the IRR changed after this change in the product?
Yeah, Prem, it would be safe for you to assume that given what you heard me talk about in the last several calls and conversations, we are extremely IRR focused. So at no stage will we take a decision that will compromise IRR. Any changes that we make of the kind that we made in Tathiawadi, any tactical decisions we make will always be driven towards trying to get incremental IRR. So in this case as well, the whole thinking about repositioning the product, and we actually went back to the drawing board, redesigned it, got approvals again, was to improve the IRRs. It is debatable whether the margins would be lower because the idea is to drive high early velocity, but then recover margins over a period of time. And we've shown that in Kalyan, for example, where over the last, since the launch over the last year, we've been able to take price up by almost 8% in a market which was in lockdown and the pandemic, and there was lots of commentary about distressed pricing in real estate, but we've actually taken price up by 8% in that project.
Sure. Thank you. So second question was on the transaction that was done with our group entity wherein we're planning to buy this land parcel in Pune. And we've seen you do these kind of transactions with group entities earlier as well. But for some reason, all of these transactions have been kind of outright transactions. Does it mean the group is not open to JDAs or we're still kind of making them understand that it will be beneficial for both of them if you get into a JDA wherein for you it will be a little lower capital intensity, but they also stand to benefit from the development margins that you would be able to make on these land parcels.
Yeah, Prem, honestly, you're perhaps reading too much into this. These have been small transactions. So the Pimpri transaction was, I think, 3.5 acres or so. Getting into the overhead hassle of a JDA for such a small transaction makes no sense. So as we get into some of the larger transactions, the JDA model is certainly on the table. Both JDA as well as other constructs around that would certainly be on.
Sure. Okay. Sure. So just one last for Vimal sir. I think our net debt, it's kind of bookkeeping only. Our net debt has gone up by almost 40 odd crore rupees during the quarter sequentially. Fair to assume essentially because of Kanakpura transaction, because for your other transaction, as you earlier mentioned in your opening remarks, you still to make the payment because it is linked to approvals. And the fact that this year we've done seriously good in terms of inventory liquidation, we've completely exhausted the entire inventory at Luminaire, which was higher value, wherein the cost was already taken care of. We have sold wind chimes as well. I was under the impression that the cash flow should ideally be better than generation should have been ideally better than what we've been able to kind of manage. So does it mean, there are some projects or there are some delays in milestone payments, or you have extended additional timelines to your customers to make the payment because of COVID issues?
Yeah. So, I'll give you a couple of numbers, which is at overall all entities, simple consolidation level. 31st March 2020, we had cash in hand of roughly about 225 crores. 31st March 21, that cash in hand went up by about 25 crores to roughly say 240-250 crores. And therefore, overall cash availability in our sector entities has gone up. What it means is that we are holding on to the cash and hoping that we'll be able to utilize that cash much efficiently. And all these numbers are including partner shares and all of that. So that's one. Second, more specifically, we did had some good negotiations with the financial institutions in quarter 4, and therefore we partly funded the Kanakapura deal through that, because once you have completed the negotiations, opened up the line, you are expected to at least start using that line, and that was the exact reason why we went ahead and used that. But overall cash flow of internal accruals continues to be extremely good, and one of the sort of best year we have seen in COVID. So no worries at all on that front.
Sure. How much was construction spend during the quarter and the full year? I mean, if you could share that number, please.
Roughly, we would have done about 250-260 crores in the last 7-8 months. I'll not be able to tell you the quarter number. It's not really.
I'll take it offline from Sumit. Sure. Thank you. Thanks a lot.
Thank you. The next question is from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity, and my condolences for the loss of your team member. My question was slide number 15, where we are saying that we have 4.71 million square foot available for launch. How much of that is expected to be in the current financial year?
Sorry, can you say that again? I missed the question.
So in slide 15, we have indicated that the forthcoming launch area is 4.7 million square foot. So my question is, how much of that is expected to come in this financial year?
We will have. Sumit, you want to take that?
Hi VP, this is Sumit here.
Hi.
I think of this 4.71 million square foot, we are expecting to launch Luminaire project. We will open up further phases of Tatavade. We are planning to open up further phases in Alcove during this fiscal. And also in terms of new projects, Kanakapura and MWC Residential. These are the projects we are expecting to launch. Now, out of this total area, how much we will open as phase 1, phase 2 is something that will be a tactical decision closer to the launch based on the market studying information and feedback. But these are the typical projects we are planning to launch this fiscal. Now, Arvind also highlighted that we have done few deals recently, like Kalyan deal as well as the Pune deal with the M&M. The working is we are working towards getting these projects also ready for launch this year, and considering the market situation, those also may come up in the market this year itself. So I think in all fairness, out of 4.7, probably more than 3.5 million square foot worth of projects at an aggregate level are expected to come up in the current year. Now, how much area will be opened up will, as I said, is a tactical decision closer to the launch.
Okay. And by when would you have a sense of that, right? That, 4.71 plus whatever you add in terms of your land bank, that and so out of that, there'll be, let's say, 2 million, because this year I think you did about, if I'm not mistaken, I think I saw that number somewhere.
About 1 million square foot of launch.
About 1 million, correct, right. So about 1 million. So I'm just trying to ballpark, against that 1 million when we only were working for 2 quarters, what is the likelihood of, should we assume it will be definitely north of 2, or should we assume it will be closer to 3? I'm just trying to get a directional understanding of what to think about.
Arvind, you want to take that?
Yeah, my sense is certainly north of 2. Would be a very safe assumption. Just to explain why, we're not putting a very firm number to it at this stage. So let me take Tatavade as an example. Tatavade was a 1 million square feet project. We've registered the first phase, which is roughly half of that, which is 5 lakh square feet. But our launch was for about 3.5 lakh square feet out of that 5 lakh square feet. And those are very in the moment decisions depending on what is the competitive activity, what is the window of opportunity we see. In Tathawada's case, we knew that the stamp duty exemption is getting over by end of March, so we wanted to bring in inventory that most of which will get sold before the end of March so that customers can get the stamp duty benefit. So there are many factors that play into that in terms of just what inventory you release at a particular launch. But it would be very safe to say certainly 2 million plus should be brought to market this financial.
Okay. And Arvind, my question on the demand side, you said it's very strong. I was just wondering, now that the stamp duty benefits are out of the way for customers, what is the read of the situation now? Do you expect it to be coming down a little bit? What's your sense on the demand side?
Yeah, so look, if it were a normal year and the second wave and lockdown had not happened, I would have certainly expected that in Maharashtra, Mumbai and Pune, April would have been a slow month because of the withdrawal of the 2% stamp duty benefit. The fact that there was lockdown, of course, accentuated that, but it would have anyway been slower than February and March. But I expect that by June or so, things will recover again, quote unquote, in a normal environment. If nothing else had happened by, these things typically, these shocks take 2 months to wind themselves down. Eventually, we must understand a house purchase is a multi-year decision. Families have typically been planning for it for 2 to 3 years. They've started saving up for the initial payment. So a 2% change in price or total value is not going to sway their decision on whether to buy or not.
Mm-hmm. Okay. All right. And on the IC side, I was just wondering if the international travel is minimal. Are we just closing these deals online, or how is it that happening that we are consummating these deals on the IC side?
So combination actually. So we have closed certain deals remotely with some of our clients in Taiwan in particular. But several clients have also been domestic clients who are either seeking expansion, so multinationals who are present in India and seeking expansion and therefore are able to take decisions locally, but also Indian companies who are setting up facilities.
Okay, wonderful.
And I think there's been one of the, as I said, in such a challenging environment for our team to close these deals remotely. 6 months back, we were all wondering, can homes be sold online? And we showed that we can sell homes online with our Palghar launch, where it was entirely zero touch. The fact that we are also able to in a limited way, but still able to sell industrial land online without them visiting the site is actually quite remarkable.
Yeah, it's commendable, and kudos to your team. That's all I had. Thank you, Rohit.
Thank you. The next question is from the line of Rohit Koti from Marshmallow Capital. Please go ahead.
Good afternoon. First, my condolences to you and the team for the loss of your colleague. My first question is on the 2 mid-premium projects that we launched in Mumbai, Vicino and Alcove. Given the tailwind and the stamp duty, are we happy with the sales that we have registered so far, or has some of them been some of it overflow into April and it was not registered for the previous quarter?
Look, when you ask a CEO, are you happy with sales? I can never be happy. I would always want more sales. So I think it's been, under the circumstances, these are very different products. Vicino attracts an audience which is a bit more spread out geographically, different pin codes in Mumbai. Alcove is a very targeted product that attracts geographically a very concentrated market. It's people generally who live within a few kilometers from that project site who are interested in buying there. So the velocities will inherently be different. I think Vicino has done more volumes over the year than Alcove only came in March, so it's premature to judge based on 1 month. We are seeing pretty good walk-ins on both the sites. I think Vicino has a longer track record. It's also further in its construction cycle, therefore has a different set of demand dynamics playing there compared to Alcove. So not unhappy with either of them. Of course, I would want more sales in both.
Thank you. That was helpful. My next question is on the slide. It's on the management team. So over the last couple of quarters, you've mentioned how, you're happy with the team that you've created and we are set to scale to the next level and maybe beyond as well with the team that we have. But I just wanted to hear your thoughts on how you're incentivizing the team, because my observation is that most of them have come from, including yourself, have come from organizations which are much larger in scale in comparison to where Mahindra Lifespaces is today. So how are we motivating and incentivizing them and aligning them with the shareholder return over the long term?
Yeah. So look, I think, Rohit, two things. One, this is a team that has come together with a certain sense of purpose, and that is always the starting point to create a leadership team and then to create the culture down the organization. In almost no case have I had to attract these people by throwing a lot of money at them. In many cases, they've actually taken slight haircuts in compensation to come and join us because they believe in the cause that we are trying to build. This is a company that is trying to seek its space, its legitimate space, its rightful space in an industry which is rapidly consolidating and formalizing. And I think many senior professionals are excited by that phase of the journey that we are on and what we are seeking to create. But that being said, that alone is not enough. And as you rightly said, there needs to be a financial incentivization. So we do have a stock plan, which the senior leadership team is part of, where their incentives are very clearly linked to share price performance.
Understood. That was helpful. My last question is again on the medium-term target that you have mentioned in this call and the previous calls. Internally, is there anything that you think that needs to be done, or is there anything that needs to be done for us to reach the target, or the only hurdles you think that can come are external and internally we are all set to meet that goal?
No, it would be foolish of me to believe that everything is hunky-dory. I think there's a lot of work for us to do internally as well to be able to scale up and deliver, year on year, 4 to 5 million square feet of both sales as well as delivery. Requires us to invest in capabilities, invest in systems, processes, teams, all of that. So that is not a story that is behind us. That is still a story that consumes a lot of my time.
Oh, great. Thank you. That's it from me.
Thank you. The next question is from the line of Parikshit Kandapal from HDFC Securities. Please go ahead.
Thanks for the follow-up.
Hello, Parikshit. Hello.
Yeah, can you hear me?
Your audio is not coming clear.
One second. Hello.
Yes, sir. Go ahead.
Yeah, Parikshit.
So my question was, you highlighted about the residential target and you were sticking to it, but what about the IT business? So by FY25, how do you see the leasing momentum moving up there? We are already having about 1,000 acres plus of inventory with us, which is unleased. So from the current trend, if we take the fourth quarter benchmark over 25, 26 acres of leasing, so how do you see it ramping up annually, say by 25?
Yeah, look, I think great question. Again, by FY25 in the IC business, we need to be at 500 crore plus of annual leasing revenue. I think that's very clear to us, both from a opportunity perspective and a supply perspective, given the land we have and the quality of the land and infrastructure. Anything lower than that would be a shame.
So about 200 acres annually. So that is what you're targeting. And this is achievable by like some 23 or like, so what is the target?
Similar time frame, 25.
Okay, 25. We have seen in Pune that area has gone up from 400 acres to 500 acres. So there has been an addition during this quarter there.
Which you're talking about the Pune...
Industrial, yeah. That 400 acres is now about 500 acres.
Yeah, so the first phase there is going to be about 500 acres and I think it's always been in that range. As we get more clarity on the availability of land and the contiguity, those numbers get revised. So now we have a line of sight to doing a contiguous 500 acre phase.
Okay, and when do we launch it? Any timelines of when do we bring it to the market? And how much is the pending investments to be done for land payments to be done here?
The pending investments are minimal. A lot of it has already been incurred, and the cost of acquisition is quite low. I expect this to come to market in about 2 years' time. So this year we will stitch up most of that first phase of land and the access, etc., and then go into master planning and launch. So I would say in 2 years' time is when it will realistically get launched to the market.
So any update on the Ghodbunder land now, sir? Because I think we were earlier targeting FY23 launch. So are we on target there? So if you can update us on what status of that project.
Yes, same as what I mentioned last quarter. Progress continues to be steady, and we are on target to launch that in FY.
Just one question on the Mahindra, this land which you acquired. So typically when there is this kind of transaction, so how does the talk get initiated? So how do you go about doing it? And are there any other land parcels being targeted for this year with the group? Any large land banks where you're looking to buy out or enter into some JD? So some visibility there, if you can provide us, and even if you can cover the Kandivali land there as well.
Yeah, look, we are in constant touch with M&M on their various land parcels and when they seek to monetize those. We are, in a sense, we have visibility into the pipeline. Given they're a listed company, as I mentioned earlier, we do need to.
Arvind, we are not able to hear you.
Participants, please stay connected. Line from Mr. Arvind has dropped. Ladies and gentlemen, please stay connected while we rejoin Arvind for back to the call.
Sure.
Hi, sorry, I think I dropped off.
Go ahead, sir. You're connected to the call.
Yeah. Okay. Sorry, Parikshit. So I don't know where I got dropped off. I was saying with M&M, we are in constant dialogue, so we understand their pipeline of land and when they would seek to monetize certain land assets that they have. But that being said, as I clarified at the start of the call, they are a listed company, we are a listed company. We do need to ensure that all of these transactions are done in an arm's length manner with requisite care taken for related party issues, which is very important to both companies and to the group from a governance perspective.
Okay. This is the last question on this, your target. So I think in media interview you have said that 2,500 and 5,000. So even in the call you said 5,000 crores is what you're looking at. So which looks like FY25 looks to be more a very conservative target of achieving this 2,500 crores. So I can clearly see from your pipeline and even on your BD initiative. So do you think it's a conservative guidance and we'll get there faster?
Well, look, tough to say. Let's see this year and next year play out. This is a business where I have learned over the years that one shouldn't get ahead of oneself. So let our actions speak louder than our statements.
Okay, Arvind. Thank you a lot. Thank you. That's all from us. Thank you.
Thank you very much. Ladies and gentlemen, due to time constraint, we'll take last one question. The next question is from the line of Arpit Ranka from Koval Investments. Please go ahead.
Yeah, hi, good afternoon. So I just want to understand that how well equipped we are to kind of protect our profitability across cycles. So you mentioned we underwrite projects typically in early 20 for operating margins. And we also aspire to sell as much as possible at the launch in a way, right? So what I'm trying to understand is, let's say there is a 3-4 year project cycle. 50% is hypothetically say land cost, which is kind of locked in. But the other 50 is open to inflationary escalation, which we are facing currently. What if they sustain, let's say, during these 3-4 years, and we've already locked in the customers, but the cost side is still open to negotiations with contractors and all. So even a 20% escalation here could create and eat away into our potential margin. So how do we ensure that we are able to protect our profitability? And I think this applies to industry as a whole, not just us, but I'd love to hear your thoughts on this.
So look, I think your question is very pertinent. This is a business that has changed in its economic profile over the last 5 to 10 years. It used to be a very high margin business. It's now a moderate margin, and at least for most of the organized players, we are we are running it as almost like a manufacturing factory. That's one of the reasons why I had mentioned in earlier calls and conversations that we don't want to get into very large land parcels which are multi-phase, takes you a decade to monetize, etc. We want to get in and out of projects quickly within 4 to 5 years, turn a project around, exit it, and if necessary, if we find the market attractive, we'll buy a second land parcel in the same market, just like we have it done in Kalyan. So that's one strategy, to kind of contain the exposure so that we don't get locked into long cycles which are unpredictable and expose us to a lot of risk. The second is, as you rightly said, as costs escalate, one has to go back to the drawing board and redo product, do a lot of value engineering. So we have built up this capability within the company to continuously sharpen our pencil from a cost of execution perspective. Even with the same design, how do we value engineer it so that we can shave off a few percentage points of cost is a constant endeavor and a constant challenge that we keep throwing at each other.
Okay. No, that's helpful. So one final question on earlier in the call in your commentary mentioned that on IC and IC, one of the aspirations by 2025 is to kind of bring out the hidden value or something like that. Now, what do you mean by that? Like, of course, one is the growth side of it, but structurally, do you see that that's also part of your aspiration for 2025 for the business? Because I think over the last 15 years, the ROEs for this segment has been at best low teens, right? Certainly not around anywhere close to 18% or something, and that's unlikely to change as well, I presume. So how are you thinking about it beyond just the growth aspect of it, which we may benefit over the next few years?
Yeah, look, I think you're absolutely right. Over the last 10 to 15 years, this business has been challenging from an ROE perspective. But for all the reasons I mentioned earlier, with the macro climate, the global supply chain realignment, etc., I do believe strongly that this business will also have its moment in the sun over the next few years. And we want to be ready for that in all possible aspects. I think we are ready from a infrastructure readiness and site readiness perspective. What we do need to work on and beef up is our go-to-market in this business. And how do we cast our net wider, be much more relevant to customers with the kind of offerings we have, do much more than just pure land lease business, layer on a bunch of value-added services on top of it, which creates the income stream. Those are all areas that we are working on.
Okay, so it's just fair to understand that significant equity is unlikely to be committed to this space and embark on another 10-15 year cycle, or do you think that that's also a possibility that exists?
No, at this stage, I don't think that we have significant equity outlays that we are envisaging for this business. We think the investment cycle is behind us and we need to now ride the value creation.
No, that's it. Stay safe. Thank you.
Thank you very much. Ladies and gentlemen, I'll now hand the conference over to Mr. Arvind Subramanian for closing comments.
Thank you, Nirav. Thank you to all of you for your participation and patience and the vigorous discussions we've had. Just to round up, as I said at the start, 3 areas that we are focused on and are committed to deliver to our promise. One, on the residential business, making sure that we get to that first milestone of 2,500 crores of sales by 2025. We think we are in a perfect storm where we have favorable industry realignment happening around us, and that should enable us to do that with us. And the idea is to build to that in a sustainable way so that from 2,500 we can go to then 4,000, then 5,000, etc. And the IC and IC business, where, as I said, the investment cycle is behind us. We believe the future is about how do we create significant value on top of the pioneering investments that we've made. So with that, let me once again thank you and request all of you to stay safe and stay well. These are extremely challenging times, and I wish all of you and your families the best of health.
Thank you very much. On behalf of Mahindra Lifespaces Developers Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.